What's up, guys? It's Rob here, and today we're going to be talking about the Federal Reserve and their plan to double interest rates tomorrow. All right, we're going to be talking about the timing, what the market is potentially going to be doing in response, and a whole lot more. So let's take a look, first of all, at this, right? Analysts rather, are very fearful that the Fed could be making a mistake tomorrow, right? They're worried that doubling the interest rates could have a negative effect on the stock market. People are saying that at this point, no matter what the Fed does, recession is inevitable because of all the inflation that's existing. And we are expecting a doubling of interest rates tomorrow. Currently, interest rates are set at 0.5%, and they are expecting that the Fed will double them tomorrow to 1%. So, all in all, it doesn't actually sound that high when you say it that way. And in reality, it's not even that high, right? We've got three things going on tomorrow: the FOMC statement, the interest rate decision, where they're expected to double interest rates to 1% from 0.5%, and the press conference. Now, we're obviously going to hear Jerome Powell speak tomorrow. He's probably going to say some things to try to soothe the market, but also to quell inflation at the same time, right? That's what he typically does. He never wants to crash the market, but at the same time, he knows that he has to combat inflation, and he's trying to do it with these interest rates. However, even if they double rates to 1%, which is right about here, it still wouldn't even be as much as what we were at pre-pandemic and pre all that money printing and pre all of this inflation, right? There is so much inflation out there. 8.5% is the latest CPI reading that we've got. People are actually feeling inflation a lot more than 8.5%, right? This is what the government's coming up with. In my opinion, I feel like it's really a much higher number if you actually take into account what people are spending. But however they do their calculations, they came up with 8.5% for the CPI. And 1%, in my opinion, is not going to cut it. That is not going to make it more worthwhile to hold cash than to hold assets. And here's why, right? If you look at the stock market, you will notice that we have actually been feeling some pain lately, and that over the past year, we've also been feeling some pain, right? We're actually, just as of yesterday, hitting almost lows for the past 365 days for the S&P. And in my opinion, we've gotten way too low, right? I think we've moved down way too much on all of these inflation fears, because at the end of the day, inflation isn't bad for stock prices, right? Inflation isn't supposed to be bad for stock prices. It's supposed to be bad for the value of the dollar. And you can see that the value of the dollar has consistently been dropping throughout pretty much all of US history. And so there's no situation where I'm going to see massive inflation and inflation going up, and that's going to cause me to sell out of assets, to cause me to sell out of stocks and other assets like gold, silver, crypto, to hold cash, when cash is the thing that's being inflated away, especially when the Fed is combating this inflation so minorly, right? They're raising interest rates to 1% to combat 8.5% inflation. So there's still real massive inflation out there. Even if you're holding cash, you're still inflating away, even at the low inflation rate that the government says there is, at 7.5%, right? 8.5 minus the 1% interest rates that we're expecting to come in tomorrow. It's still not going to do much, in my opinion, right? I think it's really too little too late, in my opinion, right? I think that the Fed is being a lot more lenient regarding this inflation situation than a lot of people would have hoped, at least for people who are holding cash. I think they would have hoped the Fed would be a lot more aggressive with these interest rate hikes. And at the end of the day, it goes to show that the Fed is the friend of the market, right? They're there to support the market. And the market, even though it is moving down temporarily, I don't expect that will continue, right? I think eventually people will catch on to the fact that the Fed really isn't doing all that much to combat inflation, that they're really not raising interest rates all that much, and that their targets for the end of the year are around 2.5 to 3% for interest rates. And that's still not going to be combating the inflation that we've even seen last month, right? And inflation is only expected to grow. So that's just my opinion. I'm not going to be selling any stocks or anything like that because of the Fed being expected to double interest rates. But that's just my opinion, not financial advice. Other than that, guys, feel free to subscribe to the channel by hitting this button right here. Potentially, I'll figure out how to make it work. And you can just hit that button right there if you want. Other than that, though, have a great day. I'll see you in the next one. Bye.